In this video, I'm going to be going over how much money it takes to retire using the Dividend ETF JEPI. And JEPI is a very popular dividend ETF for income investors. It provides a really good high yield and also good quality underlying holdings as well. And it's also an ETF that I own myself in my portfolio, so it just goes to show that I believe in this ETF as well. A little bit of a brief overview of this dividend ETF. The ETF is the JP Morgan Equity Premium Income ETF. And it is designed to pay high dividends, as the name suggests, with the name having income included. It has a decent top 10 holdings here, with each holding very narrowly centered around a fixed point. So you're really not going to see that much variability in the top 10. And the most recent yield of this ETF, the 30-day SEC yield, is approximately 8%. Which is a fairly high yield among dividend ETFs. Of course, there are dividend ETFs that do pay a bit higher, but as far as dividend ETFs go, this ETF does pay pretty well. Now, the methodology of this ETF is to generate income through a combination of selling options and investing in U.S. large cap stocks, seeking to deliver a monthly income stream from associated option premium and stock dividends. And it also constructs a diversified low volatility portfolio, so it keeps your money even safer during market downturns. And the overall objective is to seek to deliver a significant portion of the returns of the S&P 500 index with less volatility in addition to monthly income. So as you can see, the main objective here, of course, is to provide monthly income for people. And I did use dividends quite a bit, but it's important to know that a good portion of the income that you are receiving is through options premium. And that is going to be important later when we get into how much money it takes to retire off of this wonderful ETF. A little bit more about the income received from this ETF. 1 to 2% of the income you receive is going to be coming from dividends from those underlying holdings. The other 5 to 8% approximately is going to come from options premium. Now, this fund doesn't directly sell options, but it uses something called an exchange-linked notes. And for all intents and purposes, those do have associated options premium that they get income from, and then that distributes it to investors. So this fund itself doesn't really sell those options, but it uses an exchange-linked notes to kind of get a quasi-option premium. So what does it mean to have a dividend ETF that doesn't only get its income from dividends, but also associated options premium? That means you're going to have a very volatile dividend, and every dividend is not going to be the same. Some will be higher, some will be lower, based on the overall volatility of the market. Of course, when volatility expands, the option premium investors receive also expands. It is one of the things when it comes to options that you learn about. In short, all you have to know is a market that goes up and down a lot is typically seen as more volatile, and that will impact these payments here. And as you can see, there really is no rhyme or reason to how much you're getting paid out, because it all depends on the market itself. But you're going to see quite a bit of variability in these dividend or income payments that you're going to be getting every single month. Now, because this income ETF does pay a variable dividend every single month, there really is no sure way of knowing how much money you're going to need to put into this ETF to retire, because again, that income is always going to change month to month. But we can do a bit of forecasting, and we can use the conservative side when it comes to these dividend payments to kind of get an idea of how much you need to invest to retire using this ETF. So I'm going to do this calculation with some assumptions in mind, and then you can just modify these calculations to fit wherever your circumstance is in life. Of course, it's difficult to forecast exactly how much someone needs, because it's all going to be variable depending on their own circumstance. Of course, you have this here, which goes on to cost of living in a household with 1 person, 2 people, 3 people, and so on and so forth. And of course, that's also going to vary where you live and just the overall cost of living in the areas. So I am going to use what this website says for the average cost of living for 1 person, and this is done in 2022. But we will kind of forecast and say that now the average person single person in a household, their cost of living is $48,000 a year. So we have that much in lock. We need $48,000 a year to survive. And how can we make that up with the dividend ETF JEPI? And then on top of our cost of living, we also need an expected dividend payment. So how much income is our investment going to make per year? And again, these payments are volatile, but based on how this ETF operates, you're very likely not going to get less than 5.5% from income year over year. So I am going to assume that your annual expenses are $48,000 a year. And then with this ETF, you are not going to get under 5.5%. If you do, that's great. All the extra income you could use for whatever you want. But let's just forecast 5.5%. And I think that's good because in retirement, the hope is that you really never run dry. So anything above 5.5% is going to be great. But we really want to push this conservative side and use 5.5% just so that we do have a little bit of room to vary there. And this calculation is very simple. So all you're going to do is you're going to take the dividend yield and then the cost of living and then divide these numbers together. So you're going to do 48,000 divided by 5.5%. And what you're going to find is that you will need $873,000 approximately to retire using this dividend ETF, assuming that your cost of living is $48,000 a year. And assuming that the dividend yield you will be getting from this ETF is 5.5%. Now we can move that number around a little bit just to get an idea of how different factors influence it. So for example, if the dividend yield is 6.5%, which might be more likely for this ETF, but again, I used 5.5% to be on the conservative side. But with 6.5%, you only need now $740,000 to retire, and that is about $130,000 less than what you would have needed before. And of course, this also works for the cost of living. If you also change this number around, you're going to get an idea of what you'll need. And of course, with $75,000 as the cost of living, you're going to need about $1.2 million, assuming that the dividend yield is 6.5%. So again, this dividend yield is going to fluctuate a bit based on the ultimate volatility of the market, but expect over 5.5% for your average dividend yield that you're going to be getting for this ETF. Now, as I said before, I do enjoy this ETF. It provides high income and overall less volatility compared to normal equities. It's a great ETF, in my opinion, to have through retirement for that income and then ultimately less volatility. Remember, if you did enjoy this content, give this video a like to help get this content out there to a wider audience. I'd greatly appreciate it. And also subscribe to keep up to date on future content. And I'll see you all in the next video.